Hey guys, Dave Keller here with Market Misbehavior. One of our most popular videos are the Choose Your Own Adventure style video. What's next for the S&P 500? Today, here as we complete the first week and a half in June of 2023, let's take a look at where we're at right now and decide together what's next for the S&P 500. So the purpose of these videos, thinking about what's next for a particular chart or particular asset, is based on what we call probabilistic analysis. What we feel is very, very important is that you don't just think about your particular narrative, right? Your particular investment thesis and then ignore all the others. A well-rounded investor really considers all the different possible outcomes and then starts to weigh them, like an odds maker weighing different outcomes in a football game, right? Think about the different potential outcomes, how likely different outcomes might be, but also really think through each of those different scenarios, because by forcing yourself to think outside of your own thesis and think about the different possibilities, it allows you to be less surprised when one of those different occurrences may actually play out. This has served us very well, for example, in 2021 and late 2021, thinking about super bearish scenarios. So once that bear rotation happened at the beginning of 2022, it sort of made sense because we'd already thought through that environment. When the market went lower and lower and then eventually found a bottom into October of 2022, we'd already talked about some potential bullish scenarios, what that rotation might look like. So once we started to see the signs actually play out in the data, we were already able to anticipate it. Today we're going to focus in on that 4,300 level on the S&P 500 and think about 4 different potential outcomes. And I would invite you to vote in the comments below. Which do you see as most likely and why? By the way, if you like the sort of thinking about market history, technical analysis, and behavioral investing, go ahead and subscribe to my channel. Also, give the video a like if you appreciate it. We'd super appreciate that back. Let's get to the chart here. This first chart is my own chart of the S&P 500. It's super busy. I like to tell people I use charts as a workbook, as a conversation you're having with the markets. So by analyzing the trends, by drawing notations, by putting comments, which I don't usually share those comments publicly, but use the charts as a way to capture your thinking, because that allows you to go back and reflect on what's changed and what you may have noticed or not noticed at some point previously, and what you can learn from that. Now, we're going to talk about the 4,300 level. That's the pink shaded area on this chart. And I will point out a couple things. Number one, here's the October low in 2022. You can see the higher low in December and then a subsequent low in March. That's right around that 3,800 level. We're going to come back to that in a little bit as well. Now, 4,200 was the resistance in February and April and then May. We finally broke above there at the end of May and now have followed through to the upside. Now we're reaching 4,300, which is the August 2022 high. So sort of that 4,300 to 4,325 range, sort of the sweet spot of where we're at. We, about a week ago got up to this level at the end of the previous week. Now here on June 9th, we're trading above once again, but closing right back below the 4,300 level. Now, why do I keep saying 4,300? Why is that so important? It really comes from 2 different things. Number one, the August 2022 high was right around that point. So once we broke through the February 2022 high, which was pretty meaningful, we've now gotten to this next key area of resistance. Now you look above here, what's left if we break above 4,300? Well, 4650 would be the high from April or March, actually, of 2022. And after that, it's the all-time high just above 4,800, around 4,818 for the S&P 500. Now, this 4,300-ish level also represents a 61.8% retracement level. Fibonacci analysis I find super helpful. It gives you what I think of as a framework for the markets. If you're looking at a bigger picture and just trying to understand where we're at relative to where we've been, particularly after we've had a significant move, Fibonacci retracements can be super helpful. Take the high from January of 2022, take the low from October of 2022, and you'll see that the rally into the November peak, sort of this choppy period and pullback, was all around the 38.2% retracement level, which is right around a big round number, 4,000. We broke through that. That cleared the way for the 50% level, just above 4,150. That's where we reached in February. We pulled back. We tested that a couple times and finally broke above 4,200 in May. Now we're at that last Fibonacci retracement level. So based on a pure Fibonacci analysis, if and when we get through that last level, that suggests a retracement 100% of the way back to the all-time highs. That's what the general use of Fibonacci retracements would apply. Now, there's a secondary level up here in the 70%-ish range, which some people use. I'm not a big fan of that level, so I'm not showing it here, but that's one other thing you may want to play around with using your own charting tools and the Fibonacci framework. But let's get to our nice, fresh, clean chart of the S&P and think about what are the different scenarios over the next 6 to 8 weeks for the S&P 500. We'll go from the super bullish, the mildly bearish, and the super bearish. Here's scenario 1, the super bullish scenario. So what would happen here? Well, obviously, we would not just hit 4,300, which we've done here so far. We would continue to break higher. We would continue on. I would argue the super bullish scenario means you get not just to 4,600, but we retest the all-time highs in the next 6 to 8 weeks. So it is indeed a super bullish scenario. Now, again, this sort of exercise is not just about thinking about what could happen with the price chart. It's also thinking about what may happen with the dynamics, right? What would cause that environment? What would create that environment where risk assets would rally so much further than they have already here as we start to wrap up the second quarter of 2023? Well, I would argue it's all about the mega cap growth stocks, the FANG stocks, Meta, Amazon, Netflix, Alphabet, Apple, Microsoft. These are NVIDIA and other semiconductors. These are the stocks that have really had the lion's share of the gains in 2023. If you take those stocks out of the picture, 2023 has actually been a pretty choppy, flat to negative year for the average stock in the S&P 500. But those mega cap growth names have really driven and really dragged the markets, the indexes higher as they've pushed to the upside. So I would argue that trend would have to persist. Charts like Apple that are testing all-time highs would have to break through them and go even further, and that would propel the S&P 500 up into that 4,700 to 4,800 range. So scenario number 1, the super bullish scenario would most likely mean those mega cap growth stocks really continue to work. Other stocks that have been struggling, things like energy and financial, some things that have started to rotate higher here in recent weeks, would really have to participate. That would turn breadth indicators way more positive. Advanced decline lines would start to rotate higher. Stocks would get above their moving averages, so all that breadth data would start to improve. And overall, that would be the very bullish scenario where stocks continue to build on the gains they've seen so far year to date in 2023. Scenario 2, the mildly bullish scenario. We're not able to make new all-time highs in that case because that's the super bullish scenario. Mildly bearish means we get above 4,300, but we don't get much further. I would say we hold below 4,600. We sort of fill in this sort of range. The mildly bullish scenario means the rally that we've seen in the mega cap growth stocks, maybe that goes a little bit, but maybe they start to lighten up their leadership role. But I would argue the other stocks, things like financials and energy, really start to improve to the point that they're able to, the maybe stalling out that we see in the mega cap growth stocks is overcompensated from, overcompensated with the those value-oriented sectors like financials, energy, maybe even industrials and materials. Those stocks are strong enough. The breadth data starts to really improve. That would maybe hold the market up to just above current levels. Get us above 4,300, but not enough upside momentum, right? Those mega cap growth stocks that really need to shine don't shine as brightly, and as a result, our growth-oriented benchmarks aren't really to propel much further. So that would be, we continue to go higher. We certainly don't go lower, but the pace of the uptrend that we've seen over the last couple months starts to slow down quite a bit. That's scenario 2, the mildly bullish scenario. Scenario 3, the mildly bearish scenario. This is where 4,300 starts to hold. If you vote for scenario 3, you're probably saying that the S&P doesn't get much above current levels. 4,300, which is a significant resistance level because of the Fibonacci analysis we shared earlier, but also because of the August 2022 highs. It's just too much for the S&P to eclipse. As a result, the uptrend that has gotten us here starts to unwind a little bit. In this scenario, I would argue the mega cap growth stocks don't just stall up, they maybe start to rotate lower a little bit. If the mega cap growth stocks rotate lower and the value stocks that have been underperforming like financials and energy, if they rotate higher, our growth-oriented benchmarks will rotate lower. So even though energy and financials start to improve, those growth sectors are just too big of a weight. And if they start to roll over, if Apple fails to make a new all-time high and starts to rotate lower from resistance, that's going to bring our major benchmarks a little bit lower. The Nasdaq's certainly going to struggle. The S&P doesn't get above 4,300 with any meaningful way. It starts to rotate lower. But I would say scenario 3, the mildly bearish scenario, means we sort of back and fill, probably in that 4,000 to 4,300 range. We don't get much lower, but we sort of hang in this range. And I would say the scenario 3, the mildly bearish scenario, I would give it all the way back to the December 2022 low and the March 2023 low. So that's getting us down to sort of in that 3,800 range. So I would say scenario 3, the mildly bearish scenario, keeps us between 4,300 and 3,800. That's quite a lot of room to back and fill. But scenario 3 means we sort of chop in this range, and we may even put on a higher low, which ends up being long-term bullish, but maybe in the short term over the next 6 to 8 weeks, it's more weaker than stronger. That brings us to the doomsday scenario. Regardless of how optimistic you ever are, always consider the doomsday scenario. Scenario 4, the super bearish scenario. What would cause things to unwind in a big way? Goes without saying, 4,300 is a ceiling. We don't go much further. We really start to rotate lower. I would say the mildly bearish and the very bearish scenarios really play off the seasonal tendencies. June, July, August actually tends to be a pretty rough series of months for stocks. Summer doldrums is what we often talk about. Sell in May and go away really plays on that traditional tendency of the markets to really take a break, even during a bullish phase, take a break in the summer months. The very bearish scenario would mean that would really have to take hold. All the excitement, the AI bullishness that has gotten us to this point really starts to unwind. Maybe the inflation data starts to heat up again. Maybe geopolitical issues start to flare up. Maybe there's additional instability, implying that all of the optimism in the growth stocks that have fueled the rally so far in 2023 all start to get trouble, get a lot more cloudy. To get down there, it would not just have to be the growth stocks not working, but other things would have to rotate lower. In that scenario, you would most likely see very defensive sectors like utilities start to improve, probably go down on an absolute basis a bit, but really improve on a relative basis. When the market really starts to rupture, you get defensive like utilities, real estate, consumer staples start to improve. So that ratio of consumer discretionary versus consumer staples, which we talked about earlier this week, I'll put a link in the description for you if you want to review that further. That would really have to rotate lower in these bearish scenarios as well. So I would say scenario 4, the very bearish scenario, takes us below S&P 3,800, and the next 6 to 8 weeks we are indeed testing the lows from 2022 down in that 3,500 to 3,600 range. So those are your 4 choices. The super bullish scenario, we break above 4,300 and continue much further. The mildly bearish scenario number 2, we break above 4,300, but we sort of stall out. We don't get above the March 2022 high around 4,600, but maybe sort of fill in some of that range between current levels and that resistance. Scenario 3, the mildly bearish scenario means we stall out at 4,300, but we don't get below those March 23 lows. Sort of back and fill, continue maybe with a mean reversion back to the lower end of the trend that we've experienced over the last 6 months. Scenario 4, the very bearish scenario, we break down, and we break down big time. The S&P goes below 3,800, and 6 to 8 weeks from now, we're talking about a retest of the October 2022 lows. Which of those 4 scenarios do you see as most likely, and why? Let me know in the comments below. For Market Misbehavior, I'm Dave Keller. Be well, stay safe. We'll see you again soon.